So today we're talking about the lifetime capital gains exemption. So say you've built a business and you are ready to sell it. And you've worked for the last 5, 10, 15 years, you've dumped a whole bunch of money in, a ton of time, and you want to make sure that you're keeping as much of that sale in your pocket as you possibly can and reducing your tax bill. Well, the lifetime capital gains exemption applies to small business corporations, qualifying small business corporations, or QSBCs as they call them, where you could actually tax shelter up to $883,000 of capital gains. So the way it works is, say you invested $200,000 into your business and you've built it up over the last 10 years and you're ready to sell it for $1 million. Normally that would be an $800,000 capital gain, but under the LCGE you can actually tax shelter up to $883,000, meaning that that full taxable or that full capital gain is not taxable to you. So there's massive savings there. So how do you qualify for the LCGE? There are effectively 3 criteria. The first criteria is the 24-month test. And what the 24-month test says is that you've just had to have owned the business for 24 months. Fairly straightforward. The second test is what we call the 50% test. And what that means is that 50% of the assets of the corporation have to be used towards generating active business income. Now that's income that is the primary function of the business, as opposed to passive income, which is typically just, okay, I hold retained earnings inside of my corporation and then reinvest that money. So you at least 50% over the last 24 months has to be used to generate active business income. The third test is what we refer to as the 90% test. Technically, the test says that substantially or all. However, 90% is the general rule of thumb to meet the proper criteria for that test. So 90% of the assets in your business need to be used to generate active business income at the time of sale. So the 50% test is over a 24-month period, and the 90% test is at the actual time of sale. So now that you know the 3 different criteria, the 24-month test, the 50% test, and the 90% test, what do you need to do to make sure or ensure that you do qualify for the LCGE? Well, the first one, it's pretty straightforward. You just have to make sure that you own the business for 24 months. So for example, say you've owned the business for 20 months and you want to go sell it. Well, it might make a lot more sense to wait 4 months and you can defer the sale so that you qualify for the LCGE. Another important thing to note is that, say you only incorporated the business 6 months ago, but you've been a sole proprietor running that business for the last 10 years, you'll actually still qualify for the LCGE. For the 50% test, it's just more a matter of making sure that you need to rearrange any assets if possible and maybe hold them in that structure for a 24-month period to make sure that you meet that 50% test. The 90% test is typically the one that we have to play around with a lot more when a client goes to sell a business. So there's something we refer to as purification. And so if you've owned a business for say 10, 20 years, you might have built up a considerable amount of retained earnings that you have left inside of your business to defer paying personal taxes on that. And so we might need to do a couple things. We might look at rolling dividends or dividending through to another corporation like a holding company, or we might look at dividending out to the business owners to make sure that we purify that corporation so that it meets that 90% test. All of those are fairly straightforward processes, but it's important that you do it because if there's a few $100,000 on the line, you just want to make sure that it's done properly so you don't have to worry about it. If you have any questions regarding the LCGE, qualifications for it, or things that you might need to do when you're looking to sell a business, feel free to reach out and we'll be happy to get you the right information.